One of the biggest hurdles aspiring homeowners face is coming up with the funds for down payment. Now, there are a variety of ways in which you can do this, from down payment assistance programs to gifts from friends and family members. But there is another way that, while feasible, goes against the popular opinion of some financial experts. In today's video, I'm going to explain all about using retirement savings for buying a house, including what rules you need to follow, the taxes you might have to pay, and some smart ways to handle your money so you can still have a comfy retirement. If you've been putting money aside for years in a retirement account, you might wonder if you can use some of it to help pay for a new home. Well, the short answer is yes. You can take out money from your retirement account to help you cover things like down payment, or closing costs for that matter. But there are good and not so good sides to doing this. Now, before I get into that, what exactly is a retirement account? Well, retirement accounts are special types of investment accounts that help your money grow over time. So you'll have money to live on when you're older and not working anymore. They are usually a 401k, 403b, or an IRA. Now, a 401k is a retirement savings and investment plan offered only by employers, for-profit and nonprofit. A 403b plan is an employer-sponsored retirement plan that's very similar to a 401k plan. The key difference is that 403b plans are offered by public schools, churches, and 501c3 nonprofit organizations. An individual retirement account, or IRA for short, is another type of retirement savings plan that you get on your own. With an IRA, your money can grow without having to pay taxes on it right away, which means you keep more of what you save for retirement. Now, there are multiple versions of 401ks, 403bs, and IRAs. I won't get into all the ins and outs of these. I just want you to be aware that there are various types of accounts that you can get. These are great vehicles to quickly build your retirement funding through the employer matching contributions. In both 403b and 401k plans, the employer match is a good thing for employees. When your employer matches your contributions, it means they're also putting in some money towards your retirement. This encourages a lot of people to save more for their retirement and also lowers the amount of money that they pay on taxes. This is free money, so if you have access to this type of program, take advantage of it. If you already have been, this could be a good source to use if you don't have much money saved up to buy a house. Beware though, the government gives you the tax benefits on these accounts to encourage you to save for retirement so that you don't have to rely on the government when you're in your winter years. There's two ways to tap into these funds. First, you can borrow money from your 401k or 403b. You just need to check with your employer on how to do so and what the IRS limitations are. Exercising this option, you'll not only avoid the 10% early withdrawal penalty, but also the amount you withdraw won't be subject to income tax. Additionally, when you take out a loan from your 401k or your 403b, it doesn't get included in something called your debt to income ratio, which is a measure of how much debt you have compared to your income. Finally, the credit bureaus, which keep track of your credit history, they don't consider this type of loan. So borrowing from your 401k or 403b won't make your credit score go down, and it won't make it harder for you to get approved for a mortgage. As I stated earlier, there are some drawbacks to taking out a loan against your 401k or 403b. For starters, it's a loan, so you'll have to pay it back with interest. Somewhere between 1% and 3% is pretty much typical. Also, your employer may not allow you to contribute to your plan until that loan has been totally repaid. That means you can't take advantage of the matching funds your employer offers, and you lose the effect of compound interest while that loan is in place. This implies that your retirement savings might not grow as fast as you think or as much in the long run. And if you leave the company, you still have to repay that loan in full. Usually it's by the next tax filing date, but sometimes it may be even sooner. So if you decide to use this option, make sure you have job stability. Now, rather than borrowing from your 401k or 403b, you can make a withdrawal, just like at a bank. This way usually is due to a hardship, and the rules for this vary from company to company. So you're gonna wanna make sure that you check with your employer for the specifics on how you can do this. Remember, the IRS offers this type of investment tool to you on a tax-deferred basis. That means your planned contributions come out of your paycheck before any taxes. This lowers your taxable income. So if you're someone who says, you know what, I can't afford to contribute to a 401k or a 403b, you actually can't afford not to. The difference between what you'll take home is rather small. It's really insignificant due to the lowering of your taxable income. Now, with these types of accounts, you have to pay taxes on them when you start taking out retirement payments at about 59.5. So if you take money out of these accounts before you're supposed to, you'll most likely pay a penalty of 10%. And that's on top of what you're going to owe in income tax, usually somewhere about 20%. So in other words, if you pull money out, you'll only receive about 70% of what you request to withdraw. So you'll have to put on your math brains to figure out what numbers you're going to need in order to take it out to be able to purchase that home. And that's why it's super important to think very carefully before you decide to use this method of pulling out your retirement just so that you can buy a house. If you have an IRA, it's a good idea to check there first for extra money before thinking about taking money out of your 401k or your 403b prior to retirement age. The differences between a 401k, 403b, and an IRA is that one, the first two plans allow for more money to be contributed each year on a pre-tax basis than an IRA. Two, IRAs are what we call self-directed, which means they tend to have a little bit more investment options that gives you greater flexibility and control in terms of what you can choose. And then three, 401ks and 403bs come through an employer and they offer that matching contribution that I talked about earlier, or that free money. Traditional IRAs don't have that benefit. Now, there are things called simple IRAs, which allow employer contributions. But again, I'm not going to get into the scope of all that in this particular video. IRAs have special rules that help first-time home buyers, people who haven't owned their main home or their primary residence in the last 2 years. Now, first-time home buyers can take out up to $10,000 before incurring that 10% early withdrawal penalty. But the amount taken out is still subject to state and federal income tax. And if you exceed that $10,000 threshold, you will get hit with that 10% penalty. Again, this is a great way for you to come up with the funds you need to purchase a home, but you need to proceed with extreme caution. Using money from your retirement savings might seem like a quick solution when you need cash for a down payment on a house. It's possible that you can do this without facing too many penalties, but it's best to think of this as a last resort. So before you dip into your nest egg, think about other options, such as getting a loan with a low down payment, maybe an FHA or a VA loan, or using DPA funds available in your city or your state. Now, I've done a few videos on those, so watch to the end of this one and I'll post those up for you. Now, as with anything affecting your financial future, you'll need to discuss this with either your financial advisor or possibly your tax accountant, just to determine whether this is a sound strategy for you. Again, this is for you, not anybody else. So you're gonna need to do some analysis. For example, the average return on the S&P 500 over the last 10 years has been roughly about 11%. How much will a house appreciate in 10 years? Now, the rate of home appreciation varies greatly by location, and it's also dependent on what's happening in the market at that time. However, on average, homes have appreciated between 3% and 5% annually over the past 10 years. So if you're comparing percentages, the stock market has a better rate of return. But when you compare those figures to the actual investment itself, maybe not so much. For example, if you invest $50,000 into a retirement account and you get an 11% return on your investment, that would land you roughly $122,000 at the end of 10 years. Not bad. But if you were to purchase a house, let's say for $600,000, housing prices in your area are definitely going to be different than from mine. Let's say you get a 5% return on your investment. your home would be worth over $977,000. That leaves you with $377,000. So which one would you choose? Now, there are some subtleties that I didn't account for, such as what it's going to cost you to cash out of your stocks, i.e. capital gains, and then the fees that come associated with selling your home, not to mention the maintenance and the repair costs that you're going to cover over those 10 years. But you get the gist. It may be more advantageous to use your retirement funds to buy a home over the long run. Just make sure you're speaking to a tax professional or a financial advisor to get all the information you need to make the best possible decision for you. At the end of the day, this is your money, yours. None of us can force you to do anything with it. That's totally up to you. But you have it, so use it to your advantage. Just make sure you're doing it wisely.